The unthinkable just happened again. The United States have been downgraded by the last big credit rating agency. This is not clickbait. It's a serious signal about America's finances. The big three rating agencies have now all stripped the US of its perfect AAA credit rating. Today we explain why credit ratings are important, who issued the downgrade, the consequences, and what it means for the future, in plain English. A credit rating is like a trustworthiness score. It tells investors how likely a country or a company is to repay its debt or default. The highest grade is AAA, meaning extremely safe. Lower grades suggest more risk. Just like a lower credit score means higher interest on your mortgage, a lower national credit rating can mean higher borrowing costs for a country. Credit ratings up to BBB are considered investment grade. Anything below is considered high risk or junk. Here's an example of different countries' credit ratings. For decades the US held a flawless AAA credit rating. That changed in 2011 when S&P downgraded it to AA+, amid a bitter debt ceiling standoff between Republicans and Democrats, citing political dysfunction and a lack of a credible debt plan. It was the first downgrade in US history and sent shockwaves through the markets. The rating held a AAA elsewhere, until Fitch followed in 2023, lowering the US to a AA+ as well. They warned of worsening debt and poor fiscal governance, especially after another debt ceiling standoff. Then, in May 25, Moody's also cut its rating to a AA, pointing to the ballooning 36 trillion debt and surging interest costs. This completed the trio of downgrades, all citing similar themes: fiscal strain and deepening political gridlock. The warning signs have been building for years. US government debt has climbed steadily, now topping 36 trillion. The debt ceiling, first introduced in 1917 to impose fiscal discipline, has been raised or suspended nearly 100 times, often amid political standoffs, and the cost of carrying that debt is exploding. After a long period of low interest rates, the recent rate hikes have changed the game. The US now pays over 1.1 trillion per year just to service its debt. This money is not going towards infrastructure, education or defense. It's simply the cost of past borrowing. Currently, about 14% of all federal tax revenue goes straight to servicing debt. And that share is expected to rise sharply, as older bonds issued at much lower interest rates must be rolled over at today's higher rates. This is the concern behind the downgrade. Not that the US will default tomorrow, although its debt-to-GDP ratio has risen to eye-watering 122%, but that its long-term fiscal path is increasingly unsustainable, and political leaders have so far failed to change course. When a country's credit rating is cut, the effects are not always immediate, but they are real. Just like individuals with a lower credit score faces higher borrowing costs, a downgraded US government must offer higher interest rates to attract buyers for its debt. And with over 36 trillion in debt, even a minor uptick in rates costs taxpayers hundreds of billions more over time. For example, when news of the downgrade hit, Treasury bond yields ticked up, as some investors demanded a bit more return for their perceived risk. Over time, higher Treasury yields can flow through the economy, influencing rates on mortgages, business loans and other credit. US Treasury bonds are the backbone of the global financial system, given their unmatched liquidity and scale. They serve as the global benchmark for a safe, risk-free asset. They anchor everything from pension funds to central bank reserves and the pricing of complex financial instruments. When that foundation is questioned, even just a little, it takes a bite out of America's credibility as the world's financial superpower. There are also technical consequences. Many pension funds, insurance companies and global investors operate under strict guidelines that favor or even require AAA-rated assets. That means in certain bond indices, US bonds no longer count as AAA. The good news is many investors have adapted the rules since the S&P 2011 downgrade. Otherwise, excluding US debt would be unthinkable. If you found this breakdown helpful, consider subscribing for more insights on global finance and economics. Thanks for watching.